The mortgage moratorium created the biggest trap in housing market history, and it's worse than even experts predicted. Banks are now foreclosing on homes at a record pace, with Q4 2024 showing a 47% increase in foreclosure starts compared to Q4 2023. Welcome back to the channel. Before we dive into today's video, I need you to understand something crucial. What we're seeing in the housing market right now isn't just another cycle. We're witnessing the aftermath of the largest artificial market manipulation in real estate history, and it's creating both devastating consequences and once-in-a-generation opportunities. Let me paint the picture of exactly what's happening right now. During the pandemic, the government implemented what seemed like a lifeline, the mortgage moratorium. Millions of homeowners were told they could pause their payments, take a breather, and figure things out later. It sounded perfect on paper, but here's what they weren't told. This wasn't debt forgiveness. It was debt deferral, and the meter was running the entire time. Think about this. During the moratorium period, we saw the lowest foreclosure rates in modern history. Banks literally couldn't foreclose. The market looked stable. Housing prices soared. Everyone thought we'd avoided a crisis, but what we actually did was create a pressure cooker, and now the lid is coming off. Let me show you the real numbers that nobody's talking about. In Miami alone, short sales and foreclosure listings have jumped from representing 5% of the market to nearly 18% in just the last 6 months. In Phoenix, pre-foreclosure notices are up 312% compared to last year. And in Denver, we're seeing more foreclosure starts now than we did in 2010 at the height of the last housing crisis. But here's what makes this situation truly unprecedented: the hidden interest trap that's about to spring on millions of homeowners. When people took advantage of forbearance, many didn't understand that interest was still accruing on their unpaid balance. They weren't just postponing payments, they were silently accumulating massive additional debt. Let me break down what I call the triple trap effect and show you exactly why this situation is far more severe than most people realize. We're going to use real numbers from actual cases we've seen in our research. Let's take a typical homeowner who got a mortgage in 2019. We'll call her Sarah. Sarah bought her home for $400,000 with a conventional 30-year mortgage at 4%. Her monthly principal and interest payment was $1,910. When the pandemic hit and the moratorium was offered, Sarah, like millions of others, took the forbearance option. She had lost some income from her business and thought this would help her get back on her feet. Here's where the first part of the triple trap kicks in: the delayed payment accumulation. Over 3 years of forbearance, those missed payments didn't disappear. They stacked up. At $1,910 per month, that's $68,760 in missed payments alone. But that's just the beginning. The second part of the trap is what we call the silent killer: continued interest accumulation. While Sarah wasn't making payments, her loan was still accruing interest on the full balance. On her original $400,000 loan, that's an additional $48,000 in interest charges that kept building. So now we're looking at nearly $117,000 in total new debt, almost 30% of her original loan amount. But here's where it gets really interesting, and this is the third part of the trap that nobody saw coming. During the moratorium period, home prices skyrocketed. Sarah's house, which she bought for $400,000, was worth $600,000 at the peak of 2022. This created a false sense of security. Many homeowners thought, well, even if I have to sell, I've got all this equity. But now we're seeing price corrections in many markets. That same house might be worth $500,000 today, and values are still trending downward. Let me show you what this means in real numbers across different markets. In Austin, Texas, we're seeing average home price reductions of 12% from their peaks. In Boise, Idaho, it's even more dramatic. Some neighborhoods are down 18%. And in parts of California's Bay Area, luxury homes have seen price drops of up to 25%. Now multiply this effect across the millions of homeowners who took forbearance. According to the latest data, approximately 3.2 million homeowners entered into forbearance during the pandemic. Of those, about 850,000 are still in some form of loss mitigation with their lenders. And here's the shocking part: nearly 40% of these homeowners haven't made a single payment in over 2 years. This wave of distressed properties isn't hitting the market all at once like we saw in 2008. Instead, it's coming in stages, and understanding this pattern is crucial for both investors and buyers. Let me explain exactly what's happening on the ground right now. First, we're seeing what we call the silent listings, properties that aren't technically in foreclosure yet, but where owners are desperately trying to sell before they hit the point of no return. These properties often start with subtle price reductions, then bigger ones, until they hit a critical point. We're tracking one property in Sacramento right now that started at $789,000 in October, dropped to $749,000 in November, and just listed this week at $679,000. The owner has mortgage payments that adjusted from $2,800 to $4,200 due to an ARM, and they're running out of options. The banks are handling this differently than they did in 2008, and this is crucial to understand. Instead of foreclosing immediately, they're working through a process that we call the staged recovery. Here's what's actually happening behind the scenes. Banks learned from the last crisis that flooding the market with foreclosures crashes prices and hurts their bottom line. Now they're strategically releasing properties and working with homeowners through short sales when possible. Let me share some numbers that aren't making the headlines. According to our research and market data, banks currently have what's called a shadow inventory. Properties that are seriously delinquent but haven't been put into foreclosure yet. In Florida alone, this shadow inventory represents about 14% of all mortgaged properties. In New Jersey, it's close to 12%. These properties aren't showing up in traditional market statistics yet, but they're coming. Here's what makes this situation different from 2008 and why it's actually creating bigger opportunities for those who understand the market. Back then, most foreclosures were on properties with little or no equity. Today, many of these distressed properties have significant equity. They're just trapped by the triple trap effect we discussed earlier. The owners can't refinance because rates are too high, can't make their payments because they're too far behind, but they do have equity they need to protect. I'll give you a concrete example from our own market research. Last week, we analyzed a property in Phoenix that perfectly illustrates this situation. The owners bought it in 2019 for $425,000. They entered forbearance in 2020, and now they owe about $498,000, with all the accumulated interest and missed payments. The property is worth about $600,000 in today's market. They have equity, but they're still facing foreclosure because they can't make this $7,200 monthly payment it would take to catch up on their mortgage. On a side note, if you are in a really desperate situation like that or know someone who is and they happen to have an FHA mortgage, tell them to look into the payment supplement program that's being kept on the hush for unknown reasons. We'll include a link to that in the description. This brings us to the opportunities in today's market, and we're going to share exactly how smart investors and buyers are capitalizing on these situations. But first, let me be clear. This isn't about taking advantage of people's misfortune. It's about creating win-win scenarios that help homeowners avoid foreclosure while creating opportunities for buyers and investors. Look at what's happening with interest rates. We're sitting at 7.11% right now, up from 6.61% last year. Everyone predicted rates would be in the low fives by now. Instead, they're hovering above 7% even after 3 Fed rate cuts. This tells us something crucial about our market. We're in uncharted territory. The old rules don't apply anymore. Let me share a real case study from last month. In Denver, an investor we work with identified a property where the owners had been in forbearance. They owed $620,000 on a house worth $750,000. Sounds like plenty of equity, right? But here's the catch. Their new monthly payment to catch up would have been $5,400, and they were making $8,000 per month combined income. The math simply didn't work. Here's what smart investors are doing in these situations. They're creating what we call rescue equity deals. In the Denver case, the investor offered to take over the property at $680,000. This gave the sellers enough to pay off their loan, cover their closing costs, and walk away with some cash instead of a foreclosure on their credit. The investor got a property about 10% below market value, and the sellers avoided disaster. But here's where it gets really interesting for both investors and buyers. These opportunities are appearing in waves, following a pattern we've identified across multiple markets. Wave 1 is happening right now. These are the voluntary sellers, people who recognize they're in trouble and are trying to get ahead of it. They typically have the most equity and are the most negotiable because they're trying to avoid the foreclosure process entirely. Wave 2 is starting to build. These are the properties entering the pre-foreclosure process. The owners have received notices but still have time to act. This is where we're seeing the biggest discounts, often 15 to 20% below market value, because time is becoming a critical factor. Wave 3 is just on the horizon. This will be bank-owned properties hitting the market. But unlike 2008, these properties often have significant equity. Banks are being more strategic this time, but they still want to move these properties quickly. If you're looking to invest in a foreclosure, you can be first to know when foreclosures hit your target market by signing up for free alerts on foreclosure.com to catch investment opportunities the moment they arise. We'll have the link in the description below. And let me give you some specific numbers. In Phoenix, Wave 1 properties are selling at an average discount of 8 to 12% from market value. Wave 2 properties are seeing discounts of 15 to 20%. And the few Wave 3 properties that have hit the market are selling 20 to 25% below market value. Let me walk you through exactly how to identify and act on these opportunities, because timing and approach are everything in this market. We're going to share the exact system that's working right now, not theoretical concepts. First, let's talk about identification. You need to know what we call the distress indicators, specific signs that a property is likely to become available at a discount. Here's what's actually working in today's market. Property tax records are showing us that about 22% of homeowners who took forbearance are now behind on their property taxes. This is a leading indicator that most people miss. Let me show you how to find these properties. Take Phoenix as an example. We recently analyzed 100 properties that showed tax delinquencies. Of those, 73 had taken forbearance during the pandemic. And here's the fascinating part. 58 of them were still owner-occupied, with an average of $175,000 in equity. These aren't underwater properties. These are opportunities to help homeowners protect their equity while creating deals for investors. The next step is what we call equity stack analysis. Here's how that works. Take a property's current market value, subtract the mortgage balance and any delinquent taxes or HOA fees, and then subtract another 8% for closing costs and realtor fees. This gives you your equity reality number. We're finding that about 60% of distressed properties still have positive equity after this calculation, but the owners can't access it through traditional means because of their payment history. Here's a real-world example from last week. A property in Sacramento's Elk Grove neighborhood. Current market value, $685,000. Original mortgage, $495,000. Forbearance debt, $89,000. Back taxes, $12,000. HOA liens, $4,800. Selling costs, 8%, $54,800. Real equity, $29,400. This homeowner has equity but can't refinance because of missed payments. This is exactly the kind of opportunity smart investors are looking for. Please take 2 seconds to help us out and hit the like and subscribe if you find this video interesting so far. Each like and subscribe helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, let's continue. Let's talk about approach. The old way of sending letters saying, "We buy houses," doesn't work anymore. These homeowners are more sophisticated and they have options. Here's what's working instead, offering structured solutions that protect the homeowner's credit and provide a smooth transition. This might include lease-back options, flexible closing dates, moving assistance, credit repair resources, and short sale facilitation. Let me share the exact negotiation framework that's working in today's market, because traditional approaches aren't cutting it anymore. What we're about to show you is based on actual deals that closed in the last 60 days. First, let's talk about initial contact. The biggest mistake we see investors making right now is rushing to make an offer. Here's what works instead, what we call the equity preservation consultation. Instead of saying, "I want to buy your house," you're walking homeowners through their actual options with real numbers. Let me share a conversation we had just last week with a homeowner in Tampa. Their mortgage was $420,000 originally. After forbearance, they owed $512,000. The house is worth about $600,000 in today's market. Most investors would rush in with a lowball offer around $500,000. Instead, he sat down and mapped out 3 scenarios. Scenario 1, traditional sale. Market price, $600,000. Minus agent fees and closing costs, $48,000. Minus mortgage payoff, $512,000. Net to seller, $40,000. Scenario 2, foreclosure. Credit damage for 7 years. Potential tax liability on forgiven debt. Eviction on record. No control over timeline. Scenario 3, structured purchase. Purchase price, $550,000. No agent fees, direct purchase. Guaranteed close date. Flexible move-out. Credit intact. $30,000 cash to the seller. And dignity preserved. Here's what's fascinating. When you present options this way, price becomes secondary to certainty and control. The homeowner chose Scenario 3, even though it meant less money, because it solved their bigger problems: time, certainty, and dignity. Now, let's talk about structuring these deals. The traditional cash offer isn't always the best approach. Here's what's working better: what we call hybrid solution structures. Let me give you a real example from a deal that closed in Atlanta last month. The seller needed $485,000 to pay off everything and avoid foreclosure. The house was worth $575,000. Instead of a straight cash offer, here's how he structured it. Purchase price, $525,000. Cash at closing, $485,000 to clear all debt. $40,000 seller note at 6% for 24 months. 60-day free rent back. Moving assistance allowance, $3,000. This structure accomplished multiple goals. Seller avoided foreclosure, got some money on the back end, had time to relocate, maintained their dignity. Investor got a good deal, and the property preserved value. Finding the deals is only half the battle. Having the funding and exit strategy ready is crucial. Let me share what's working right now for funding these opportunities. The landscape has changed dramatically in the last 6 months. Traditional hard money lenders are pulling back, charging 12 to 15% interest plus 3 to 4 points. But here's what smart investors are doing instead. They're building what we call equity partner networks. Here's how it works. You find a deal like our Atlanta example. Instead of expensive hard money, you bring in an equity partner. They put up the money, you do the work. A typical split structure looks like this. Partner puts up 100% of funds. You manage the entire process, 50-50 split on profits. The partner gets first right of refusal on future deals. For buyers looking to live in these properties, there's an incredible opportunity with assumable FHA and VA loans. Many distressed properties have these loans in place, and with today's 7.11% rates, assuming a 3 to 4% loan can save you thousands monthly. Let me wrap this up with 3 key takeaways about what's happening right now in the market. 1. The foreclosure wave is different this time. It's not about underwater properties, it's about trapped equity. 2. The opportunity window is opening right now, but it won't last forever. As banks release properties strategically, we'll see waves of opportunities over the next 12 to 18 months. 3. Success in this market requires a systematic approach, finding deals, structuring solutions, and having your funding ready. If you want to stay updated on this evolving situation, make sure to subscribe to the channel. We release new market data every week. Drop a comment below with your thoughts on where you think the market is headed. Remember, in times of market stress, there are no victims and villains, just problems to be solved and opportunities to help with building wealth responsibly. See you in the next video, and don't forget to hit that like button and turn on notifications so you don't miss any updates on this rapidly changing market. And watch this video next.